Hello, this is Brian Rezny, president of Rezny Wealth Management and of course the host of the Rezny Wealth Report. Great show for you this morning. If you have questions about your portfolio, your financial situation, send them to Brian Rezny at ReznyWealth.com. And do make sure you do visit our website, ReznyWealth.com, so you can learn not only about more of our TV shows, but my radio shows that come available on Sunday mornings. And if you'd like to sign up for a consultation with my firm at one of our Florida offices, that would also be great. We always like helping investors who want to make sure they're doing the best they possibly can for themselves. So always visit our website, call our office for a consultation. Let's get you back on track and make sure you can prosper not only this year, next year, and for the next 20 or 30 years of your retirement. I want to talk a little bit about retirement income today and in the search for retirement income. You know, a lot of our clients that we manage money, and I've been managing money for close to 30 years, a lot of our clients are pre-retirees and retirees. And I will tell you that in general, investors around this country, because of low interest rates, are buying all kinds of investments trying to get retirement income. But these investments often are not the right investments. People are what I call stretching for yield. They're doing whatever they can to make some money. I always hear about, hey, remember, Brian, when CDs were 10, 12%, and now I'm only getting a half or 1% on my CDs. People are starved for income. So ultimately, as an investor, you start chasing things because they look good. Everybody wants to make more money. And when you start hearing about investments that pay 6 or 7 or 8% dividends, you might get a little excited. The problem is you might lose a lot more in your principal than you'll ever make on that income. So I'm going to talk about some of the do's and don'ts about retirement income and how I feel ultimately you can secure a growth income stream for your retirement. Don't chase high income investments. Big risks, remember this, big risks are often associated with dividend investments or high dividend investments. And let me explain. There are literally hundreds of different investments that are paying 6, 8, 10, 12%. And you're like, what are those? I'm ready to sign up. Don't do it. Research needs to be done. I can tell you a lot of clients that hire my firm come from the brokerage houses. They're sold these crazy structured products, unit investment trust, crazy mutual funds, or some weird annuity that's annuitized. Ultimately, these things come at a negative impact to these retirees' portfolios. Anytime you're chasing high income above averages, it often will get you into trouble. Any investment with dividends of more than 3 to 4%, either dividend or cash flow, more than 3 to 4%, should be looked at as risky and extra research should be done. I'm not saying every investment over 3 or 4% should be avoided, but probably 80 or 90% of them should. Usually when rates are like what we have today, we got about, let's just say we're about a 2.25% on the 10-year treasury, government treasuries. When you start getting a lot past that, 3, 4% or higher, you start to get into some pretty risky ventures. These are things that can drop half their value in a matter of a month or two. So ask yourself this. If you own an investment and let's say you've got $1 million portfolio and half your portfolio goes down in value in the next 2 months by 50% and you're getting your 3% or 4% dividend stream, are you still going to be happy? Probably not. Also, remember, dividends can be cut. So anything that's paying out ultimately could be cut and you could get less money. And that can happen in bonds, various investments, whether it's on the insurance side or not. Things can be cut if times get bad. So remember, dividends are not necessarily safe and guaranteed. And ultimately, investments that you own that pay high dividend yields can be cut or eliminated. Risky income investments, I feel you need to avoid today. High yield bonds, they used to be called junk bonds. The brokerage houses now call them high yield bonds because nobody wants to buy junk. These are investments, these are non-investment grade bonds that are paying 5, 6% or in that range. These are risky ventures. They can be just as risky or riskier than the stock market is, meaning on volatility and also declines in a recession. MLPs or master limited partnerships. You know, I saw these last year where a lot of these things blew up 60, 70, 80% in value drops. And then the dividends start getting cut. So remember, not necessarily safe when you get these high dividends. Royalty trusts, things like in the oil and gas sector. Non-traded REITs, real estate investment trusts. Again, these are riskier investments, and these dividends on all of these can all be cut or eliminated if things get bad. So again, these are 4 on my hit list, and I'm going to give you a few more. Mortgage REITs. These are some of these mortgage REITs were paying 10, 12%, but the values have dropped 50, 60% in value. And guess what? As interest rates go up, they could lose even more value. We are currently in an interest rate increase environment. You need to be cautious and prudent where you get your income. These are investments to avoid. Utility stocks. People tell me, oh, I thought utilities are safe. No, they can drop a lot in value also, especially when rates go up. And by the way, valuation, utility stocks are probably amongst the highest valued stock category of the S&P, in my opinion. All long-term bonds with longer than an average 5-year maturity in today's market. Remember, you could buy a bond that's a 1-year maturity up to 30 years. Generally speaking, in this environment that we're in, this low interest rate environment, and the rates are starting to slowly move up, especially as the economy gets better, long-term bonds get hit the most. Remember, interest rates go up, bond values go down. The longer the maturity, the more they go up and down in value. So don't chase long-term bonds. I would recommend a bond portfolio, if you own bonds, bring your average maturity down to an average of around 3 years. Average 3 years, you'll still get income, you'll get some asset protection, but you're still going to get some fluctuation, but not near as much as bonds that are 5, 10, or 15 years long. They may pay a little bit more, but you could potentially lose your shirt. So again, don't chase yield. Buy things that make sense. Sometimes it's better to make a little bit less on your income and not lose 20 or 30% of your portfolio. Those of you who own a lot of bonds in your portfolio, and I've preached this all in 2016 and as we go into 2017, to reduce your bond exposure. Don't own as many bonds. And there's often the saying from Wall Street, you should have your percent in bonds based upon your age. I think that's a huge mistake also. Avoid income annuities. Avoid annuitizing an annuity if you currently have one. This is a big mistake. Income annuities are usually annuities that are sold by annuity salespeople, often at these free steak dinner seminars. They tell you about all these glorious returns and income for life. At the end of the day, what you often get with an income annuity is you get your own money paid back to you, and it usually takes about 18 years to get your own money. Think about that. Would you invest into something where it paid your own money back for 18 years? I had a client recently, we were doing a review on the phone, and she said to me, I was at dinner with a bunch of my friends, and they were all talking about how they were sold these annuities and how they get this income every single month. And she said to those people at the dinner table, yeah, but what about inflation? You're only getting the same amount of money for 10 or 15 or 20 years, but it never goes up. And they all kind of looked at her like, oh, we never thought about that. And she said, and they asked her, how'd you know about that? Well, she said, Brian Rezny is my financial advisor, and somebody tried to sell me an annuity before I hired him, and he explained why annuities were dangerous because there's no inflation protection. It's your own money being paid back. Could you imagine taking a job and having to give them your money that they pay you back for the first 18 years? You would never do it. Don't buy an annuity, and never annuitize an annuity either. Income from investments alone are not going to provide the income you need. Let me explain. Income-oriented investments that provide a yearly income stream are not going to provide enough income for most retirees today because interest rates are so low. You're going to have to look for other sources. You're going to have to look for potential growth. Let's talk about how to do that. We call it a total return strategy for higher income, or a chance at a higher income. Remember, if you have a portfolio that is total return, that's growth and income. You get both. If you add the growth and income together, that's total return. In my opinion, if you're 65, 75, or 80, you need to have a total return strategy. Some of your money has to have a chance to grow in order to provide more income down the road. Remember, you can always sell some of your growth off to provide your yearly income. Income investments alone, things like bonds, are not going to provide enough income for most retirees today. And unfortunately, most retirees haven't done the math on this. If you're 65 years old and you are married, there's an 80 to 90% chance that one of you will live into your 90s. That's better than a 25-year retirement. If your money doesn't grow, imagine living on less income every single year. You must grow some of your money. You need to have a total return strategy, and I think that is going to be important for the next decade or two for every retiree. Larry from Miami, Florida. What is the difference between a mutual fund and a CEF? Great unbiased show. Thank you. Thanks for the nice comments, Larry. A mutual fund and a closed-end fund, that's a CEF, folks, closed-end fund or closed-end mutual fund, much different. A mutual fund is open-ended, meaning as much dollars or as many dollars as investors want to add, they'll keep buying more shares. Closed-end funds, which I usually do not like, because these are kind of gimmicky. They limit how many investors can get in. There's only a set amount of shares. And what I find is most closed-end funds have leverage, and a lot of leverage. They lever up the portfolio in order to try and pump up returns, and it never seems to work. Also, a lot of closed-end funds pay principal back as part of the income stream. Yes, you're getting your own money back as part of the dividend. So if you look at a lot of these closed-end funds, unlike a mutual fund, they only pay out what they actually make. Closed-end funds will actually pay out your principal, and they'll call it a distribution. So it looks like you're actually making more than you are. The problem is your portfolio value keeps going down because you're paying your own money back, and eventually you run out. I do not like closed-end funds, or at least the vast majority. I think they're gimmicky, they're leveraged, a lot of them are risky. I would avoid them at all costs. And I also would not particularly like most mutual funds. I think you're better off as an investor with what's called an ETF, or an exchange-traded fund. As an investor, there are many tools out there you can pick from. Closed-end funds are one. One, though, in my opinion, that should be avoided. Another is mutual funds. Most should be avoided because they're a high expense ratio. Wall Street loves them, though, of course. You should hate them. But you want to take a look at what's called an ETF, or an exchange-traded fund. Low cost, liquid. Most Wall Street firms don't like them because they don't make lavish commissions on them, and the fee structure is very low, which is good for your portfolio. So take a look at those instead of mutual funds or closed-end funds. I'm going to take a short break. Please visit my website, ReznyWealth.com. Please call our office. If you're ready to erase investment stress, if you're realizing your advisor is really no more than a salesperson of the products his firm requires him or her to sell, call Rezny Wealth Management. When you're ready for the difference a real money manager can provide, you are then ready for Rezny Wealth Management. I'll be right back. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, ReznyWealth.com, and download your free report right now. And we're back, and we're taking your questions, of course. Send them to Brian Rezny at ReznyWealth.com. And make sure you do visit my website, ReznyWealth.com. I know we always get a lot of calls, investors like you that are concerned about the advice you're currently receiving. You're looking for that second opinion. You're looking for real money management. I encourage you to call Rezny Wealth Management. Experience the difference a real money manager can provide: risk management, discipline, conflict-free advice, what's good for you, and that's important to us. Call Rezny Wealth Management today. Eric from Naples, Florida. Are bank loan funds a suitable money market replacement? Great question, Eric. No, they're not. Money market funds are designed to be basically risk-free. So if you're looking just to kind of park money because you're going to buy a house or a car, you need that down payment, use a regular money market. You're not going to make anything on them, but it's going to be safe. Your value will be there. Bank loan funds, though, I will add, I think are a great opportunity in today's interest rate environment. For those investors of you who are looking for the potential for a little bit higher income, take a look at bank loan funds or floating rate security funds. There's various ETFs that actually offer these investments within them. And the reason I like bank loan funds or floating rate type bond funds is their interest rates float as rates move up. Unlike traditional bonds where you have a fixed interest rate until maturity, bank loan funds, if rates are moving up, they move up along with it because it's shorter term paper, typically 30 days or less. Rates of return and interest rates today are favorable. Don't overload the boat because all investments have risk, but I do like bank loan funds today in a rise in interest rate environment for a part of the income asset, a pie for every retiree that is looking for an income stream. Tom from Naples, Florida. What is the role of bonds in a portfolio? Do you believe in the weight of your bonds based upon age? I am 65. Tom, great question, by the way. No, I do not believe that bonds should be weighted based upon your age. I think that's a huge mistake. A lot of Wall Street firms love that scenario, but I think that is awful for retirees. Think about this. If you had $1 million and you're age 65 and you put 65% of your money in bonds that are producing 2% return today, and the rest of your money goes somewhere else, I mean, what kind of return are you going to make for your retirement? You don't have much of a chance. I do believe bonds make sense based upon your goals and objectives and risk, but there's times you don't want to have 65% of your money in bonds, and there may be times you want to have 20% in bonds or 85% in different kinds of bonds. So what I would say to you in general, because where we are at interest rates, investors today need to look at a total return strategy. I think you need to have more high dividend paying type investments like equities. Couple that with some safety of some bonds in the portfolio for income purposes, but look for the opportunity for a greater total return, growth and income combination together instead of just trying to get income alone. It's not going to cut it in today's low interest rate environment. Terry from Boca Raton, Florida. What do you think of all the negative bubble headlines you hear every day, and what should an investor do? Terry, this is what I would tell you. All the negative news you hear about, the world's coming to an end, you should load up on gold, or this has happened or that, ignore these commercials. At the end of the day, there's always going to be a lot of negative news. That's usually used to sell newsletters or crazy services to unsuspecting consumers. What I try to educate every investor is this. As an investment firm, as a real money management firm, we look at hardcore research. I get inundated every day, probably just like you do, with these crazy emails soliciting buy gold, world's going to an end type of stuff. Put them in the junk box, delete them, they're worthless. You want to look at how the economy is doing where you're invested. Is it growing? Yes, it is. Are interest rates moving up? Yes, they are. Is unemployment getting better? Yes, it is. Look at what the positives are and then invest around that. Negative headlines are there to sell you something that you probably don't want to buy, and if you do, you're going to wish you hadn't bought it. So remember, stay positive, do real research, never base your decisions on emotions, gut reactions, or some crazy headline in a newspaper or some weird email that you receive about investing. Todd from Naples, Florida. Are you concerned about equity valuations? Todd, no, I'm not. If I look at equity valuations in the U.S., we're currently trading about a 17 PE ratio to next year's numbers. That's not terrible. It's not cheap, but it's not expensive either. If you go back to, let's say, the year in 2000, the S&P was trading at about a 34, 35 PE ratio. Today, we're at half of that. So equity valuations aren't that expensive. The economy is growing. As long as the economy grows and the pro-growth policies that are being put in place work the way they should, I think earnings will come in higher. Valuations will actually be then subdued, meaning you have upside potential in the U.S. equity-based markets. I like what I see right now. Mark from Sanibel, Florida. Gabelli Utility, GAUCX, pays a huge dividend. What do you think about that fund? Mark, I would avoid it. I was talking not too long ago about utility stocks in general. Utility, and this is what this fund owns. They own utility stocks essentially. I would avoid utility stocks. Utility stocks, in my opinion, are grossly overvalued. Investors, small investors, have chased these investments because they pay a little higher dividend. That huge dividend comment you made tells me you're looking for income. The problem is you're buying something grossly overvalued for a big dividend. That dividend could be potentially cut, but you could also lose a lot of the value that you put into the investment. So I'll give you an example. If you have a 5% dividend and you lose 6% a year in principal because the asset's overvalued and it's going down in value, you've got a negative 1% a year. Don't worry just about the dividend. Consider total return. Never buy overvalued assets. And in my opinion, the utility market right now is grossly overvalued because small investors have all glommed onto that, reaching, stretching for yield, and it's going to come back to burn them eventually. It always does. And I've been doing this for 30 years. I've seen a lot of big mistakes. Buying overvalued stocks or sectors is a huge one, especially in the utility market. Sal from Naples, Florida. How can I generate income in a low yield world? I'm sitting on a lot of bonds paying 3% and cash paying nothing. Sal, great question. Again, you're the same kind of investor I hear from a lot. You're looking for yield. Look for total return. Grow some of the portfolio. You can always sell some of the growth off to provide income for your family in addition to the dividend. The problem is all your money is in bonds paying 3%. You have to do more with your money. Retirees today are not going to survive on bond interest. Now, maybe in 10 years, rates move up a little bit, you get a little bit better yield, then you position a little bit more on the bond side. But right now, and I think for the next 5 to 10 years, investors need to look more for total return, growth potential, in addition to a light dividend. Bring them together. I think you've got a great opportunity with that. You can always call my firm. We run a total return strategy for our clients. We'd be more than happy to sit down with you, discuss your needs, and help build a proper portfolio that can help your family throughout retirement. Sam in Fort Myers, Florida. Can strong corporate earnings spark a renewed rally in stocks? Sam, you hit the nail on the head. Overall, if you look at the stock market, earnings drive stock prices. So if earnings are growing, stocks tend to go up. If earnings are decreasing, stocks come down. So a great example is when the economy is in full vigor or overheated and companies start to slow down, we start to signal recession. Earnings start to decrease. We're not seeing that now. But ultimately, if we get renewed growth in earnings, I would firmly expect the equity markets to do well. And I've talked about this repeatedly on past shows and on my radio show. I like the U.S. marketplace. Earnings should be growing over the next 4 years under a Trump presidency because these are pro-growth policies they are enacting. And this should be good for not only all corporations, but ultimately great for all Americans to prosper from. Paul from Plantation, Florida. I was pitched in an Allianz hybrid annuity for income for life for my 401k plan of $575,000 rollover. What should I be leery of? Paul, bottom line, whether it's the Allianz annuity or any annuity, you should be leery of all annuities. You need to do your homework. What I'm going to tell you is this. You're going to take your money out of your 401k plan. You're going to put it in this annuity, whether it's this one or any of these other annuities, and you're basically going for this income for life. The problem is, did you calculate how long it takes you to get your own money back? I can tell you based upon those numbers and past research that I've done and people that I've worked with, It's going to take you on average about 18 to 20 years to get your own money back. So Paul, you retired age 65, let's say, you put this $575 into this annuity, they're going to pay your own money back over the next 18 to 20 years, okay? Your money's never going to increase. The money they give you, let's say it's $30,000 a year as a number. $30,000 is this year and $30,000 is next year. You never get inflation protection. Are you able to live on the same amount of money in 5 or 10 years as you do today? Of course you can't. Inflation just at 3% is going to kill your retirement income, but you locked yourself in. The problem that people have with these annuities is there's no inflation, there's often higher taxes than you were led to believe, you insanely lock your money up with big surrender penalties to get all of your money back out. But the big one is, would you take a job where you had to pay them to pay you for the first 18 to 20 years you worked for the company? Of course you wouldn't. Why would you give your money to an insurance company for an income for life and the first 18 to 20 years is your own money? That makes zero sense for you, the investor. This is the problem that I often find for every investor. You need to read that fine print. Annuities are not your friend at all. I would suggest, Paul, go to my website, reznywealth.com. You can download for free our report on our homepage of our website, Why Annuities Are Dangerous for Your Wealth and Retirement. Read it. You'll understand more about inflation's devastating impacts and how annuities in general hurt your retirement and hurt your investment portfolio because of that lack of inflation protection. It sounds good when you got into it, but ultimately in 3 or 4 years when you realize you made a mistake and you can't get out without a big penalty, it's going to hurt you even more, and now you're deeper into retirement and you have less money to work with. Do the right thing with your money, get real advice, only work with a fee-only fiduciary money manager, somebody like Rezny Wealth Management. Paul, I would urge you to call my office. Let's talk. Let's discuss your rollover. Let's make sure Paul and his family is taken care of first, instead of an insurance agent looking to line his or her pocket with a bunch of commissions. Annuities are expensive, and I do not believe they belong in anybody's portfolio. Folks, I'm close to out of time. Is your portfolio performing the way it should to meet your goals? Ask yourself that simple question. Are you questioning the advice you're receiving? You should get a second opinion with Rezny Wealth Management. We provide stress-free investment management. Let us help secure your long-term retirement so you can spend your golden years with your family and your grandkids. Get the advice you need that's best for you. Don't fall for a sales pitch from Wall Street, a bank, or an insurance agent. Don't attend a free dinner seminar that's going to sell you another annuity. Call Rezny Wealth Management and make sure you have yourself a safe and profitable day.